Um, Good afternoon. We can start. Sorry, I had to ask for a. I had to reschedule a little bit because I had to go to the doctor, and that took a little longer than expected. So let's start. I hope you're all there. I just added a bit. Where is that? For the sake of completeness, I added this. Let me just. So, for the sake of completeness, to last time's lecture, I added C caps. For those of you who are there, you will remember we went into retail payments, and we were talking about all the common switches, SIFTs, CAS, um, and I just wanted to put this here. We have discussed this earlier, but I thought for completeness it will be better to have it here. So the SEFs and CAS, which is, does anyone know what CAS is? Sorry, does anyone know what CAS is? The common ATM switch. So the common ATM switch is the switch that allows us to go and take um, cash from any other bank's ATM. That is through the cash switch. And then SEFs, I think everyone knows what SEFs is. SAS is basically the cash, but it's for financial institutions that can't that find it difficult to make the investment for that find it difficult to make the investment for to actually um, so SAS is the system that allows financial institutions that can't invest a large amount on the cash system, because when you are connecting to the common ATM switch done by Lanka Clear, it requires a certain amount of investment, and not all financial institutions can afford that. So the shared ATM switch is when a bank that has already made uh, the investment can kind of, so technically it's kind of like sharing that investment rather than them having to do the investment all by themselves. So very few banks, financial institutions use this, but uh, one good thing is sort of RDB uses it. It allows financial inclusion, and that's really the main reason why the shared ATM switch is there, because smaller financial institutions um, that can't afford to make those investments but still have a larger pool of customers who would like to use ATM cards can access the system. So we've talked about the common POS switch and then the ACS, and then CMOPS is a is was also a part of the common card and payment switch initiative, but because payment apps have become really popular, uh, the mobile based payment switch might not come through simply because SEFs has been a very successful technological innovation when it came to payments, because we've been able to extend SEFs to just pay and then to Lanka QR and then mobile apps. So just pays for mobile apps. So we feel that this might be, at the moment there is no initiative to complete the CMOBs uh, because SIFs is kind of having that extension. So the whole retail payment system, the real sort of modernization, it's not the really, I don't want to use the word modernization, um, it's more like going into the digitalized era that happened in 2013 with the CCAPS project. So that is when the central bank, the National Payment Council, everyone came together and decided, oh, all these changes are happening in the world. There are smartphones coming up. There's real-time retail payments coming up in the world. So for all that, this single project was started, and now we've completed 4 phases, and most likely the last phase we might not need to, because SEFS is already doing that job. Uh, any questions on that one? I included that into last time's slide deck. I'll share this one, and just for completeness, I wanted to add this because I felt last time it would be nice to have it in the flow. Um, and then for Lanka Clear, I added a small stylized diagram here because I want to discuss this in detail when we discuss fintech. Because Lanka QR, the model is a very good example for what is considered fintech, right? So this guy needs a name. Um, this is the merchant. Has everyone used Lanka QR to make a payment? This is um, have you all used Lanka QR? Does everyone have a mobile app in their phones? Gavin, do you have a mobile app on your phone?
Yeah, miss, but I haven't used the Lanka QR thing.
Okay. Is it a payment app?
Sorry?
Is it a payment app?
Yeah, I have used this iPay or something.
Okay, right. Rangana,
I have used it.
you have used it. Okay. Visista,
Yes, I have used it.
you have
Solo,
used it. Sorry, Solo,
solo payment. Yeah,
H&B. Okay.
yeah.
And Vidura,
I have also used it now.
you have also used it. So how has your experience been in using it?
Easy to pay, like,
Is it easy to pay? You
yeah.
don't have to tell me because I'm from the central bank. You can tell me if it's not easy to pay. It's fine. Rangana, how has your experience been?
Uh, it was easy, since there are so many internal apps also, no? So right now for bill payments, I'm using our bank app, but this is also something similar, like.
Yeah. No, have you used Lanka QR? Have you made
Yeah,
a
we are
QR code-based
we are
payment?
having a Q plus app, no? So
Yeah,
that is
yeah,
being used for Lanka QR, I think.
yeah.
So
Have you
once I
scanned the
did,
QR code and paid?
yeah, once I used that one.
Okay, right. Vidura?
I have paid several times by scanning the QR code.
Okay. So do
Like,
you like
yeah,
it
yeah,
to
yeah, it was easy and quick.
quick? You prefer it to the card?
Sorry?
You prefer it to the card? You prefer paying with Lanka QR compared to the card?
Yeah, yeah, I like.
Oh, so I'm just trying to. So Lanka QR was set up mainly not to replace cards, but mainly for merchants who don't can't get cards or don't want to use cards, because there are a lot, in Sri Lanka, cards for a normal merchant, the card charges about 3%, and that's a big amount for normal merchants, unless you're like a supermarket or someone who has a big volume and you get lower percentages. It's a fairly big amount, and we often find the merchants saying they either ask for the 3% or they prefer cash. Many times they would say, "Don't use the card. Why don't you give the cash?" And they say things like, "Kaatavat nene." When they say, what they mean is customer also doesn't get the 3%, the merchant also doesn't get the 3%, and they don't see a need to pay the bank and the rest of the service 3%. So this is to encourage digital payments. So this is 0.5%, the MDR. And that's the main reason why Lanka QR was introduced. And as you know, I think we saw those videos. It's very popular in countries like China, but in Sri Lanka, that's why I asked, one person has an app and he has never used, one person has used once, another person has used, I think, a relatively few times. Only one out of four, only one says that they have been using it more. So this is a good way to encourage digital payments, and also it's a SEFS transfer, so it directly goes to the bank accounts of the merchant. So it's good for small time merchants, especially who want the money real time. I mean, that's one reason why they want cash, because they want the money real time. And they can't wait for 3-4, and they don't want to wait for 3-4 days because they work on very small margins and small volumes. So I think depending on the situation, it's good to use Lanka QR. But what we find a lot is the merchants, the cashiers still don't know how to use Lanka QR so well. So they are a little hesitant when we offer to use Lanka QR. I made a few Lanka, I used to make a lot of Lanka QR payments, but now I find that a lot more merchants, the cashiers seem a little hesitant because they don't know how to use it. So a lot of awareness is needed when we introduce new payment systems. We can introduce new payment systems, but the adoption is very slow, because if you already have a fairly well efficient payment system, be it cash, be it card, because the customer doesn't know, right? To the customer, it doesn't matter. The customer doesn't know about MDR unless it's charged from them. So the customer doesn't know the relative benefits of uh, the alternative options. So therefore, it's very difficult to get customers to shift from one to another. In the case of China, as I said in the previous lecture, um, it was easy because they didn't have any other options. They didn't have cards; they only had cash. So QR was really easy for them, and in their little sort of market shops, they used to lose money and all of that. So when this money directly goes into their bank account, it's really safe for the merchants as well. So the merchants also started asking for QR code payments. That isn't so much the case where we find in Sri Lanka. It's very rarely that we find shops that encourage digital payments. Right. So just a stylized version of this. Now, this is how it works, right? Now, the reason I just wanted to talk about this more in the fintech part of this series was because this really captures what fintech means. The Lanka QR model that we have really captures the meaning of the term fintech. Now, what happens is, there are many types of Lanka QR payments. Now, the core feature of the entire Lanka Pay models, that is CCAPs, right? Everything that emanates from this is interoperability, right? It's switch. The word is switch, which means it's interoperable. It can connect to other systems, right? So that is the main thing. So that is why that's why I said it's an upgrade to the modern digitalized era where things are flexible. Now with apps or any digital system, now they don't make closed systems. They make systems that are open systems. Like, you can connect to other systems with APIs. Like, for instance, we can sign in to some website using Google, right? Our Gmail account. Now, automatically they connect with each other. Now, that's because they are at one point they become interoperable, right? They can connect with each other, right? So, and that is the sort of logic that modern information systems have, right? Digital systems have, which is that interoperability. And it's this. So previously, if you all take your core banking system, especially if you're in a bigger, older bank, you will see that they are closed systems. They function by themselves. It's very difficult to connect new systems onto them. And most of the time, the connection, if you actually look at how the connection has been made, it's from a very, like, sometimes the files are emailed to the other system, that sort of very basic way, because that technical link is difficult to create because the previous system is very close. There are no APIs, there are no points to connect, right? But now the systems are made in a way that they can connect. And now the way that the whole CCAPS project was to bring in that interoperability so that the entire banking, the payment systems, all the payment systems become interconnected. So that any way we can make new connections and come up with new products and services, right? And sort of speed up the process. So that doesn't have to be a break. It can just within itself just switch through, right? So Lanka Clear really so we had Just Pay, which was the first level of that innovation of extension of CCAPs, extension of CEFs going into the mobile phone, right? And then the merchant and the merchant's bank and the customer's bank could transfer money real time through Just Pay, right? So that was Just Pay was the first step. And then next came Lanka QR. Lanka QR has several types of transactions, several ways the transaction processes, right? It has 4 ways. I will discuss this in detail. I will discuss the 4 ways when we discuss fintech. So primarily what happens in Lanka QR is you have the app, right? So here I put the picture of the Lanka QR. You have the merchant. You have this app, right? So this is the connecting point, right? This is the interface. This is sort of like the payment. So this is the payment instrument or mechanism, right? It's not an instrument per se, it's a payment mechanism that links. Now, this is the point that we use to connect into the bank. We don't need to, so like the card, the debit card is the way that we use to connect to the bank account. Here, Lanka QR is the interface that we use to connect to the bank account. So the Lanka QR code basically holds the merchant's bank account details, right? But we can't see it, but that's what the Lanka QR holds, right? It's encrypted. We can't see it, but the app can read it and send the message to the so from the app we send the message to the customer's bank saying, okay, pay this much. There are multiple scenarios, right? Pay this much to this person, right? And now let's say the merchant is having another bank, right? And so customer's bank is bank A. Okay, we had this now let's say this app. Let's take the most complex scenario at first. Let's say this is solo by HNB. This but the customer is scanning from solo HNB. This is QPay as commercial bank issued QR code of the merchant. So merchant's bank is commercial bank. Customers holding a HNB app, right? So then the message, let's say that one step less from the most complex. Most complex is where the customer is holding. The most complex is where the QR code is issued by commercial bank. The merchant's bank is Bank of Ceylon. Okay, I'm just like all our different banks. Customer's mobile app is QPay. Customer's connected account to QPay is, let's say, Cargills or NTB or something like that, right? So you can have 4 banks in this picture, right? You can have a 5th person, which is the mobile app provider like OnePay, Direct Pay. Now, the reason I'm bringing all these things is to show that this is the real interoperability. All these can connect to each other because they're all connected to Lanka Pay, right? So from this single switch, all of them connect through. The message goes through to the bank to send it. In the Lanka Pay system, they see, okay, this is another bank. This is not HNB. Okay, it is not on us, it's off us. And do you know on us and off us transactions? Do you know what on us and off us transactions are? So if I go, if I let's say I have a Bank of Ceylon card, I go to the merchant and the merchant's POS has a Bank of Ceylon sticker. That means the POS is issued by Bank of Ceylon. That means Bank of Ceylon is the merchant acquirer, right? The card is also Bank of Ceylon. So that is, it's on us. It's an internal transfer for Bank of Ceylon. It is just within them, right? So it doesn't need to go all over the place. They can internally settle it. Off us is, or not on us, is where I take a HSBC card and pay at a POS which is issued by Bank of Ceylon or HNB or something like that. So then it becomes an interbank transfer, right? So this is not on us or off us, right? Then once Lanka Pay network, now it sees, okay, this is of another banks, and then Lanka Pay sends the message through, the money goes through from the customer's bank, customer gets the SMS, merchant gets the SMS, the money goes through, and the transaction is complete. But what Lanka Clear actually does is it is the interface that sends the message. It's the interface that reads the customer's, the merchant's account and pushes the money through from the customer's account. I hope it's not confusing, but it's the reason I don't go into heavy details is unless you are operating a Lanka QR at some point, or I don't know whether you need to explain these to your customers because it can get, there are 4 scenarios. I can go into detail. I generally don't go into heavy detail because you have to understand 4 scenarios. But the main point is because all of them are connected to Lanka Pay, then it's a bunch of messages that go across, and then finally the customer gets the SMS saying the money went through, and the merchant gets the SMS back saying the money has come to their account. So that is sort of the crux of what Lanka QR, very simply put. There are multiple scenarios. There's on-us scenario. Then you don't even have to go through the Lanka Pay. The Lanka Pay just kind of reverts it back. All other scenarios, the message keeps, so every time you add a new layer, let's say a new bank is there, another bank is there, another transaction acquired, or the mobile app is there, then the messages just keep going from all those entities via Lanka Pay, and then it's so within like a few seconds the whole thing completes, right? The reason I want to show this to you in the fintech scenario is when this gets more complex, each message doesn't have to go like this. It's not, I mean, yes, the messages go like this, but it happens in a central location. So that is using the features of technology. This whole thing is achieved by utilizing the interoperable features of technology. That's why I wanted to use it in fintech. So those are the things I kind of just added into this one. And we completed this last time. So I'm not going to go back. If you have any questions, you can ask. Sorry. Vidura, you had opened your, you had raised your hand.
Yes, ma'am. I think the problem with the QR system is in the practical scenario, the payment confirmation to the merchant. Because I also given QR codes to the merchants, and all the time owner of the shop was merchant is not in the shop, the cashier or someone else in the shop, and cashiers are not willing to get the payment via QR code because they can't obtain the payment confirmation because the SMS alert goes to the owner of the account, to the owner.
Yes, Vidura, that's a very good observation. That is an observation we also have observed. Even personally, I have experienced that.
Yeah. Most of the merchants reluctant to get the payment app because of this obstacle.
Yeah, so a lot of the problems come, as you rightly said, the practical scenario, because unless it's like a very small shop where the merchant is always at the shop, we have seen this situation, and then you have things like Cargills again don't have that problem because that message comes to the cashier, that cashier machine. So then again, it's not a problem for places like Cargills. They have made that development, the software development to get that message right through, so they don't need to check a phone either. It's the middle guys that this problem that this thing becomes an issue. People who don't have that sort of that integrated system like Cargill's, they're not big enough to make that development have that integrated system, and they're not small enough to be in the shop all the time because they're not sole proprietor and some they're not like a small merchant. So this situation is something we have we've been talking about how to figure this one out, whether they should come up with some small gadget for those shops, where the message and where the cashier sees this message, because the owner often walks away with the phone. And then I remember another now this this one of the shops that I go to, it's a chain, and so the cashier lady there, like uh, she doesn't like to use the Lanka QR because you don't get a receipt, right? Now, when you do the POS machine gives the receipt. And so there's something physical and visible for them to see. Some of them just don't trust the SMS because they're so used to having a paper, especially when you're not so educated and you're not the owner of the shop. It's the SMS just seems insufficient for them to prove, what if the SMS gets deleted or something like that. So these are practical issues that I think either we can solve it by more people using it and then gaining credibility by saying, no, look here, this is fine, there's nothing to fear, this works fine, or we come up with some alternative scenarios. And I think the banks are addressing these things because it is the market, because we don't want to force the market into having one type of solution. So I think the market can come up with some good solution to address this matter, because I know many of us have experienced this, and and I've seen sometimes. So like once I went to pay, and then that girl reluctantly agreed to use Lanka QR, and next day when I went, she has kept the Lanka QR aside because she was not sure how to use it. So so these are sort of the practical situations that we face. So, and these are I guess it's always when we are going to a new technology, this issue is there. Even I remember when I was paying, through Just Pay. I don't know whether you all have paid through Just Pay. If you have a mobile app like Creamy or something, you can tell in all these keys especially have this. It used to have this free me hangs out here, which means that we can pay directly using our phone number, that is using Just Pay, and then the message comes to the teller's, the cashier machine, right? And some of them don't know this, so then again they don't want to use it because they don't know how to activate the phone number based payment. But that is also very convenient as well. But of course you have to tell your phone number loud in front of everyone. But apart from that, those are different ways, but I think QR is more visible and it's much better because there's the real-time SMSs going both ways. Yeah, thank you for that, Vidura. Any other observations? No? Okay, so we can now proceed. Right. So yeah, so if you don't have any more, I'll close the presentation as the, well, if you don't have any more questions on what we've learned so far, the last part of what we did for the retail payments, we will be sort of coming again, because there are closely connected with fintech developments as well, because fintech development is mainly for retail sort of areas. So before we start today's lecture, per se, I just want to finish up that one. Can someone tell me what fintech is? Have you heard the word fintech? Anyone? Have you heard of the word fintech? This is the, have you heard of the word fintech? Gavin? Yes?
Yes.
Yes, you have.
Yeah.
Okay. Any idea that you would like to give about it? What it is? What do you think it means?
Dialogue, leasing companies, commercial companies are mostly fintech companies.
Okay. So let's learn what fintech is as we go. Gavin, any ideas on what fintech is?
Sorry?
I think simply it means financial technology. Something like
Yes. What do you think financial technology is?
like how we can like advance the technology, like using related finance, something
Okay.
like that.
Okay. Right. Yeah. That's why we should learn what fintech is, because a lot of people are not clear on what fintech is. Rangan, any ideas what fintech is?
Providing financial services through new technologies other than the traditional banking and banking channels,
Okay.
using technology to provide financial services.
Okay. Okay. Vidura, any ideas?
I think that is a technology used for financial institutions.
Okay, right. Good. So of all the definitions, I think all of them, more or less, y'all have some sort of idea. I think Rangana got closest with his definition uh, to what fintech was, but all of you are right. Y'all are having some idea that this is not the traditional thing, banking. This is, we are using technology. These non-banks are getting involved. So all these, I think, when we add all of your definitions together, your thoughts together, we are getting closer to the idea of what fintech is. So let's see what all this is about. Right. So usual. So today we will discuss types of fintech, benefits, these disruptive technologies. The words. Have you all heard the word disruptive technologies or disruptive innovation? Have you heard those words? Anyone? These are sometimes you can see these in conferences, especially last few years. They used to use these words quite a lot. This word disruptive. If you look at conference, you can type in disruptive innovations on Google. You can just type those words, and you'll find a lot of stuff with this word disruptive. So we will also learn what this word disruptive actually means. Academically, people use it for, in a very disruptive way, they use the word disruptive. So we will learn what is actually meant by disruptive as well, because as people who do this course, I think it's important for you all to know what terms actually mean, without going and using them for like how marketing people will go and use them or something like that. So then the technologies that are driving fintech and a few country examples as we go in this whole sort of in this fintech section, the entire thing. And then we'll be looking at Sri Lanka's fintech journey. There we will talk more about Lanka QR and then how fintechs get regulated, right? And then how you can promote fintech, right? So this set of slides, so it's like part 1 of lecture 5. Last time also I broke it into 2 and did it. I think we might be able to cover most of it, like most of lecture 5 today without a problem. So if you have any questions, ask. I work on these areas directly. So I work on payments and fintech because I'm in the policy division of the payments and settlements department. So this is sort of what we do almost on a daily basis. So feel free to ask any questions, anything you've learned, any new knowledge you want to bring in, you want to share, discuss, you've heard, like some random words you've heard. Read up a bit on this. Just do a Google search, like just go on Google and type fintech, type disruptive technologies, type any of the words that you come across in these lectures, and you may find a lot of things. And also remember, these areas are changing so fast, right? There are some, I'm going to try to teach you the core, like there will be a core that doesn't change, and then there's a part that is continuously developing, right? There's continuous change happening and the continuous innovation happening. So I'm going to try to teach you the stable part, and the reason I call this stable part is the part that has been stable for about the past 5 years or so, right? And then I'm going to try to teach you how to figure out, okay, what's happening next, how things move, right? Right. So what is fintech? We have some official definition. Technology enabled innovation. So this is the FSB is the US Financial Stability Board, right? So they have defined this as fintech as technology enabled innovation in financial services that could result in new business models, applications, processes, products with an associated material effect on the provision of financial services, right? Yes, so this basically covers everything, right? So when we say technology enabled innovation, so innovation is like very roughly, innovation is something, it's not invention, right? So something, it's like taking what is existing and we kind of repurpose them in a new way, kind of, if you take Lanka Clear and Lanka Pay, they didn't create new types of technologies, right? But they took the existing SEFTs architecture, they took the mobile applications, digital architecture, the software systems, the coding and all of that. Then they took QR code. Those are all existing in the world, right? Those are all existing technologies. Someone came up with the QR code, someone came up with mobile apps, someone came up with the mobile phone, someone came up with these with APIs and how to. So all these things were brought together. And when all of them were brought together, this system of interoperable, real-time, QR-based payment emerged, right? Now, before that, Freeme had a QR, but you could only use it for Freeme, like for a merchant who has Freeme. So if the merchant doesn't have a Freeme QR code, I can't use my mobile. I also have to have Freeme. The merchant also has to have Freeme, right? Freeme is ATB was the one who started QR payments in Sri Lanka, if I'm not mistaken. But their QR code is not interoperable. Lanka QR is a standard, right? As we discussed, it's a standard. So all the banks, all the QR codes now in Sri Lanka by law have to be Lanka QR, right? If you are going to have a Lanka QR payment, it is by law now. The law has said it's standardized. Everyone has to use Lanka QR. When you use Lanka QR, it doesn't matter whose bank's app you're using, whose bank account, which bank's account it's going to. It's all interlinked, and that interlink is this technology enabled innovation. That innovation was enabled because of technology, right? It's and because technology enabled us to link all of these guys together and have a real-time transaction, like bank-to-bank transaction. It has resulted in a new business model, right? Now you have create like new entities called stakeholders, like called transaction acquirer, right? Transaction acquirer is I described this last time as well. Now, OnePay or Direct Pay, they are fintech companies. They're called fintech companies or payment mobile app providers, right? Now, they are not banks. They are just app providers. So they join up with Cargills, and Cargills is the one who acquires the transaction on behalf of Direct Pay or OnePay or just a few others. And then Cargills sends the message across to Lanka Pay, right? Across to Lanka Clear. Now now we have a new guy in the business model, the mobile app provider and the transaction acquirer. So the money gets split to these new actors as well. So the business model, the interbank, if you take the CEFS model, if you just take the CEFS model, it's from one bank to the other bank via Lanka Pay. So you have whatever you pay Lanka Pay, whatever the bank charges, they will keep a bit and then they'll transfer it to Lanka Clear. And that's how it works, right? But now suddenly a new business model has been created because there are more people linking in the middle because of the interoperability. Now that is an example of a new business model, right? New actors have joined in, right? The money is getting split differently, and new people are getting money. Some guys get more money, some guys get less money. Some guys have to get more volumes. Some people have to make more investments, so the money gets split. Some people take more risk, so then the money gets split like that. And then applications, right? What are applications? Again, we'll take the Lanka QR example. With Lanka QR coming in, we have more than 20 apps in Sri Lanka, payment apps that have come up. They came up simultaneously. Some to solve the payment problem, they using technology, the mobile phone, the mobile app, they started developing. They were like, people don't have enough ways to pay. It's not smooth enough. Everyone doesn't have the credit cards. So we need to come up with some ways to solve our payment problems. Most of them are front end. So these are ABU applications, right? Processes. Again, the way the payment gets processed changes when using technology. I'm taking the Lanka QR model because we just looked at it a few minutes ago, right? Products. Again, we have Lanka QR and Lanka QR based payments. Okay, those are also called products, right? Associated with material effect on the provision of financial services, right? So how did this materially affect the provision of financial services? Right now, small merchants who didn't have access to digital payment methods now can access it because the QR code is given free of charge. Most of them get the static QR code. It's like a sticker, right? So it's free of charge. If you have a POS machine, then there's a monthly fee. Here, there's no monthly fee. So these guys are now suddenly being brought into the digital financial services, right? So it is materially changed how financial services are provided, and this money goes directly into their bank accounts, right? So no longer do they have to take the money at the end of the day and go and deposit it. This money directly goes into their bank account, right? Now do they have to wait for a few days for the money to come into their bank account? It is directly there. And also because it's a fairly low cost model, QR codes are very low cost technologies. The whole thing is low cost. That's why the MDR of like 1%, 0.5% doesn't matter so much. The banks joined in because they realized, okay, we are targeting a different group. People who use credit cards so that they can, keep keep their actual money somewhere else and get interest. And their business model is different to people who use Lanka QR, right? And also where you use Lanka QR and where you use your cards is also somewhat different. And this is mainly for places where you can't use your card. So another definition. So the term fintech, this is from an academic paper. It's a neologism. It's a new word, right? It's a created word, which originates from the word financial and technology, as Gavin also said earlier, and describes in general the connection of modern and mainly internet-related technologies. So this is another important point, right? If you look at all these fintech innovations, you will see that they are based on internet-related technologies, right? The mobile phone. If you look at the computer-based systems, at some point the internet is involved, right? In fintech, it's there. If you just look at anything that we call fintech, payment app, PayPal, whatever, the internet is involved, right? With established business activities of financial industry, right? So what happens is you take the established business activity and you connect it with modern internet related technologies and you get a new business model or a new product, right? So fintech firms is used to describe firms. The word fintech firms is used to describe firms whose business model focuses on these types of financial innovations. These firms are commonly referred to as fintechs. So the firms that engage in fintech innovations are called fintechs, right? Anything at this point? Are you all clear? Can we move on? Okay. So we have now technology has been used, right, for a long time. So what is different with this technology and the previous technologies, right? And so we need to kind of go back. Some people kind of say, okay, we've been having fintech from like 1830 or 1700 or whatever. And so we just need to go and see what are we talking about, what is this fuss about? So there have been several waves of innovation in the world, right? So first wave was mechanization. In the Industrial Revolution and where mechanization kind of started. And then to add to that, we had steam and railways coming in. So once that came together, that really changed the world because railways, then steel, which is a very robust metal, the steam-powered machines, all that mechanization just went into another level when all these came in, right? And then with that, we have this large sort of this industrial revolution that starts. And all the way up to 1970s, this industrial revolution starts, right? Again, we have another fourth wave where we have electronics coming in, TV, aviation. Again, the way people see the economy, the way people consume, the way people travel, the way goods travel, the type of goods with electronics and the types of radios, the TVs, the phones, everything changes, right? Even the machines change, right? And then finally, you have the internet age coming in, right? And then again, we see, TVs are no longer the TVs that we had when we were small, right? They are now directly connected to Netflix and all of that. They are more intelligent. They collect our own data and they analyze it and they show us different things. Electronics, right? Again, you have a lot of sort of smart electronics. You have internet connected in electronics. You have things like Alexa and all of that. If all we see all even cars and machines, they have the digital panel. It's no longer the mechanical systems that we have. So everything has changed. The way, even if you look at a car, even 20 years ago, if you open the bonnet of a car and if you open the bonnet of a new car today, it looks completely different. So these are the changes that these waves of innovation. So these are also waves of innovation. There have been inventions, and then in the midst, they have been taking different technologies and inventions and putting them together and coming up with new things, right? Then we had the phone. Now, a good example, the phone, like the chain of the car bonnet. We have the phone that used to look like this, looks like this, and now the phone is like your diary, your dictionary, your calculator. Everything is your phone, right? It has moved so far from this gadget, but we still call it the phone because it does this thing that none of the other things can do, which is we can make a call, right? And we can communicate directly with other people. So that is some of the historic waves of innovation. So then financial technology, right? So when we look at one side of it is communication, right? Now I said, where does this start? How did banking get affected by technology so much, right? Now, this story sort of begins 150 years ago, and then it starts with the underlying infrastructure to support today's global financial markets, right? Starts around 150 years ago, right? First was, so internet, all this digital, these are communications, right? You will remember the term which is not used so much now, ICT, information communication technologies, right? That is what internet and all the related technologies that come with it are called information communication technology. So it is primarily to move about messages, right? Primary thing, so moving messages is sort of the main thing, and for banking, that is sort of the crux of banking. It is moving about messages, and we know this. Swift, all our clearing systems, what they're doing all the time is moving about messages, right? And so in 1867, the first transatlantic telegraphic cable was established between the London Stock Exchange, between London and New York. I think it was London Stock Exchange and New York Stock Exchange. And once these connected, the prices, the two sides knew the prices of the commodities that were traded almost real time, right? So this really managed the markets better. So there was an immediate change in the global markets due to this transatlantic telegraph cable, right? So otherwise, London doesn't know what price it's happening is in New York or London and Paris, whichever it is. But with this telegraph, this global pricing, right, and global markets, that really changed, right? So this was the first time this changed banking and financial services, right? And then we go into interbank transactions, right? So this started in the mid, like 1960s. We looked at this in our second lecture as well. We have the first ATM at Barclays in UK, and then we have the handheld computer, the calculator, coming around the same time. And then we have in 1970 the establishment of domestic and international electronic payment systems, right? It started in the US with the FedWire, right? So this is now technology is coming into banking, right? So banking is one of the first industries to adopt technology because quick messages was very important for banking. You could that information, the information coming to you fast and in time or even early meant you could be either making or losing a lot of money, right? That was one thing. And getting the payments through, because we discussed this at the very first lecture, which is the economy is made up of completed transactions where the payment goes through. If the payment doesn't go through, that means everyone is in debt, right? The economy can't go forward. Everyone is just in debt. For the money has to move for the transaction to be complete. So the faster the money can move, the better it is, right? And then you have Nasdaq becomes electronic. We have SWIFT. All of you know what SWIFT messages are. We just learned this in 1973. And then in the early 90s, internet started getting developed, right, in the world. And then in 1997, there was the internet bubble started to grow in Silicon Valley, and then we had the dot-com crash, right? Now, we have the dot-com era, right? The dot-com era is useful for fintech because in the dot-com era, that was the first phase of fintech and changing financial services using this new connectivity of technology and the internet, right? So in 1983, I think these links are already, you can, yeah, it's all linked to the Wikipedia page here. So in 1983, this person called David Chong had come up with digital cash. Have you heard? So you all have heard of Bitcoin, right? You all have you all heard of central bank digital currency? Have you heard of central bank digital currency? Has anyone heard of central bank digital currency? No? Okay, we will be learning about central bank digital currency. I guess I'm sure all of you have heard of Bitcoin. So this is the sort of the first Bitcoin, right? And he called it DigiCash. It was the first digital cash that was created, right? And but it didn't work out. It went on for some time. In 1998, it didn't work. It filed bankruptcy, and it didn't work out mainly because at that time people didn't have internet so much. People didn't even have so many personal computers. So without that underlying infrastructure, and I talked about this several times about the customer getting the infrastructure, you know, the mobile phone, the internet connected mobile phone, the internet connected PC, this customer getting their personal infrastructure to extend the financial service value chain towards the customer is crucial for this current phase of digitalization of financial services. If the customers didn't have personal mobile phones or personal computers, then we will still be stuck with the credit card, because that is the only sort of level of technology that is affordable for a bank to give out to a customer, right? Banks wouldn't have created something like a phone for the customers for this purpose, right? The phone was created for a different purpose. Fortunately, it is very versatile. So this didn't work out, and then there was another attempt called e-gold, right? It was called internet money, right? It was introduced in um, 1996, and I think the government shut it down for like money laundering and so for these Ponzi issues and all of that. So that didn't work out either, right? In 2000, it went on to 2000 till 2008, right? And then from about 1995, this is the dot-com era, right? In Silicon Valley. If you ever go to Silicon Valley, there are two sides to it. One is where all these dot-com companies, they're all in one side. Amazon, Yahoo, Microsoft, they're all on one side, and then the newer companies are on another side. But they have, many of them have uh, survived. I mean, not many of them. They are the big ones we know have survived, right? Others, many died. Um, and so all these companies, they rose in the dot-com era, right? So pre 2000, right? Now even PayPal is pre 2000. Now PayPal was the company that really figured out what the market needed, right? The market wasn't advanced enough to need DigiCash. They didn't need a digital cash at that point. They needed a way to transfer the money, the existing money, the money that they already had in their bank accounts, over the internet, right? Because they were now companies like Amazon, eBay, PayPal was set up for eBay basically. I mean, that was where PayPal was mainly used. So now all e-commerce was coming up. Now people wanted a way to pay, right? So PayPal really caught on, and then actually PayPal was more successful in things like gambling, online gambling, and because people wanted a way to pay without using their credit cards, right? And so PayPal masked all their credit card details. It was just on an email that you can pay with. So it was very good for things like gambling, and that's how these companies caught on with the internet, right? And then 2000 dot-com bubble happened. A lot of companies crashed, but Amazon, Microsoft, now PayPal, they all survived. Um, then, okay, fintech era. Now, what we call fintech as we know now, right? Um, that story sort of starts from about 2004, right? First is the launch of Alipay. Have you heard of Alipay?
Yeah, Amish.
Okay. Sorry, who is this?
Giving.
Gavin. Have you used Alipay anywhere?
It wasn't here when I was in China for a while. Back then, I was using Alipay for a while.
It's very popular there, right?
Yeah, like even like small vendors, they usually have these kind of apps.
Yeah. So that's how. So Alipay, they use the QR code there, right?
QR code, yeah, exactly.
Yeah. So that's how. So because it was a green field in China, they didn't have people didn't have cards, or I don't know whether they even had bank accounts. So Alipay started as a mobile like wallet, and people could top it up and use it for their payments. And Alipay has grown so big, and you can use it for so you can have inter wallet transfers. You can so now it's interoperable, I suppose, with others as well. But it's sort of the main payment app in China. So, and that started in 2004 using the mobile app. So mobile phones, right? So that's where we see the real change. And then in 2007, a very important change happens, which is the Apple iPhone, which is the sort of the proper smartphone. And that changes the ease of making payment apps, right? And the ease of paying via the phone globally, right? especially now this was Alipay was in China, but if you take countries like the US and Europe, they were still not so into mobile payments in 2007 or even in 2010, right? But things like Apple started because they had the App Store, and it was quite a sort of a it was they figured out how to do it safely. So then payment apps started picking up. And again, in 2007, another important change is M-Pesa, right? M-Pesa, this is the original Easy Cash in Kenya. And so this was also launched using not the smartphone, but the feature phone, like the normal phone. So that was so at both levels, at the smartphone level and at the feature phone level, there was fintech innovation, right? Now, Visista said Dialogue is a fintech. Now, I'll bring that I'll bring that example here. Now, what happened here was Safaricom, which was the telephone company in Kenya, which is the African version of, which is the African brand of Vodafone in Europe. So they they recognize this problem of people not having bank accounts and people living so far away that they can't get to a bank, and so there's high level of unbanked, right? And again, we go back to this point of messaging, right? Financial services are made up of messages, right? And then banks realized, hey, we have this messaging, the phone companies realized we have this messaging infrastructure, right? Now Swift, any other system that you use, those are messaging platforms, right? So the phone companies realized we also have a messaging platform. Why don't we use this to send financial payment messages, right? And that is where that change, when that realization, that someone made that connection, or maybe someone in the banking who had been in banking and moved to telecom realized we can do this because we are anyway all the time sending SMSs up and down. So then they created this M-Pesa model with a digital wallet, and then the world realized that this is a possibility, right? So you have, and then at the same time you have like telebanking, which is based on the USSD code, but they really died down because it didn't matter so much. M-Pesa also uses the USSD code as well. Then in 2008, a very, very important incident, which is the global financial crisis. Have you all heard of the global financial crisis?
Yes.
Yes. Can someone just tell us what happened in 2008? Anyone would like to talk? Even simply, it's okay. It's okay if you don't worry about getting it right. I am here to correct it if it goes wrong. That's fine. Anyone knows what the global financial crisis is? Have you all studied it in your other banking courses? So the global financial crisis it's, if you don't know about it, read up on it, because it's something I think all bankers should know. And I think it happened because people forgot what banking was. And when times are good, when times are bad, we are very careful about how we give loans, the risks, and all of that. But when times are good and there's a lot of slack, there's a lot of space to maneuver, then you take more risks, because we've had companies like that in Sri Lanka as well. When they're doing well, they will have very weak subsidiaries, and they will fund them, and the, s- the they will have a whole bunch of subsidiaries, and they can all crash, and then the main companies might not be even able to bail them out, right? So this financial crisis was something like that. So with all these information technology happening, really high speed trading was possible, right? High speed trading across continents, right? US, Europe, then even East Asia, and across the globe, you could have very high speed trading, right? um, Wall Street and London and all of that. I think it was 1997. There was an East Asian financial crisis that was a bit similar to this, but it didn't have a global impact. It was kind of contained to East Asia, but they were impacted a lot. And because they were impacted a lot from that, they didn't get caught with this one, right? But of course, this was interconnected, and this became global. Of course, also the other words are, the world wars. If you take the world wars, they are mainly sort of the Western countries are get involved, and then they are called world wars. Those words are also there. So, but anyway, so this is called the global financial crisis. Of course, there's a lot of, if you take the total money in terms of global wealth, I think there was a large percentage that got affected by this. So what happened there was the people were selling subprime mortgages abroad. So US companies would bundle up mortgages that were so mortgages were getting sold as investments, right? So people would take mortgages, and these mortgages would be sold as debt, as investment instruments, on the basis that the people who took the mortgages will be paying them back, right? In US, there was a huge housing market boom, and US, UK both, there was a huge housing market boom, and people were just giving out mortgages and getting people to buy houses. So people were just buying houses, but then it suddenly appeared that these people couldn't pay off these loans, and then the mortgage went bad, and so all the related subsequent investments all went bad. So the whole thing went bust at once, right? So if hopefully you will have some in some of your courses, they will teach you the financial crisis in detail, because it's a very interesting phenomenon. I mean, this is about 14 years ago. It was very interesting for us to see at the central bank how this was panning out. Um, I think Rangana and a few others may have been in the banking industry at that time. Uh, the word derivatives and them were really popular, and and uh, and people were so when these things happen in the West, people are like, oh, they are doing it. Why can't we do it? Why have derivatives and all of that? But so it was not allowed. Central bank didn't allow it because you need to have a like an open capital account, and the money needs to both flow in and out for it to be successful. So we didn't have enough money to lose, right? So Sri Lanka has always been a little thin on its foreign exchange. So this is not allowed. And fortunately, when the financial crisis happened, we weren't affected because we didn't have any exposures. We hadn't allowed people to invest in these derivatives, these subprime mortgages and other related derivatives. And so therefore we were not impacted because we had uh, banned investment in these products. And that was, we were very lucky. Otherwise, a lot of banks would have, if they went and invested in this, they would have lost a lot of money, and we wouldn't have been able to afford it. And then, so anyway, the main point why the financial crisis is important for fintech is because a lot of people lost their jobs. A lot of bankers in the US, Europe, UK, they lost a lot of jobs, right? And also a lot of customers lost money, right? Their banks went bust. They couldn't honor their commitments. The customers lost their money. They had made investments in what the banks promised were like AAA investments, and it all just got lost like overnight, right? And with this, people lost faith in banks, right? Banks became extremely unpopular in 2008 because the place where people went and put their money, trusted and put their money, suddenly did not take care of their money, right? And then, so people tried to find alternatives to banks. Now, the way the financial system and the economy has been structured is there is a big responsibility on banks. They hold everyone's money and that's where everything goes, right? So banks are sort of a stable. There is no question of going and putting your money elsewhere, right? You don't keep it at home, you go and put it into the bank, right? It's accepted. But when banks don't do their job properly, people started to look at alternatives, right? Then they started looking at non-banks. Now, this is, you know what, my sister said, this non-banks, and she gave these examples. Now, it's not exactly non-financial institutions, but they started trying to see what sort of institutions other than the bank can do a better job, right? And so many bankers went, and then at the same time, e-commerce, internet-based payments, those were, the demand for them were growing really fast. But there weren't a lot of, even though the iPhone had come in 2007, there was PayPal, but it was pretty rudimentary, right? It was mainly for eBay. So there weren't a lot of ways to pay, and then people were stuck with credit cards or debit cards, and they were charging merchants a lot as well. So there weren't ways to pay, to complete transactions. There weren't, the banks were just holding on to their money, and people didn't have, like, people with a little money didn't have good options to invest and make most out of their money, right? So the retail level of banking was really not innovated. No, there was no development for a long time, right? People were just stuck with the credit cards and the debit cards, and because of that, the bankers who lost their jobs and the tech people who were trying to figure out, ways to get paid. They were doing work online. They didn't have proper ways to get paid. They didn't want to waste time going and doing physical things because they were digital sort of natives. And so those groups got together, and that's when the fintech started rising, right? The concept of fintech started come together when the need for financial services through digital means started becoming bigger, and people who knew finance started joining up with people who knew tech, right? And that's kind of when the whole thing started developing as a concept. And then we had in 2008, we have the first Robo Advisor. We will be looking at what Robo Advisors are. And then we start having all sorts of tech innovations. In 2010, contactless payments start. And then 2011, Alipay starts using QR code. Then in 2014, you have Apple Pay, which is introduced. So Apple Pay is NFC. Do you know what NFC is? Do you know what NFC is? Do you know what NFC is? Near field communications. Have you all?
Contactless.
Yes.
Yeah.
Yes. So exactly, it's contactless. So I've used the word contactless on top, and for Apple Pay, I said NFC. So NFC now, when you do I have my so on your bank card now you have that the like the Wi-Fi signal turned the other side. That is the NFC sign. If something is NFC. So Apple Pay, the Apple phone had NFC. Now all our phones have NFC, and now there's Samsung Pay and all of that. In Sri Lanka, we don't have those. What they did was they came up with, they figured out how to put the mobile, the credit card into the phone wallet. They created a wallet in their phone, and so you don't have to download PayPal. From the phone itself, you can just make a payment, right? So it's available in Western countries, and it's really easy. It's just like using an NFC card, right? And you can use it on the bus, you can use it in the train, you use it on the POS machine. You basically use it on the POS machine. You, instead of the card being touched, you take the phone near you and you authenticate the payment with your thumbprint, with your biometrics, right? So those are major innovations that changed the way payments were done. And then in 2018, I threw in Lanka QR here just to sort of give you a timeline of where Sri Lanka was when joining in Lanka QR, right? Right, so this is like the fourth phase of fintech, which we all see now. Apple Pay or Samsung Pay both are not in Sri Lanka because there's the wallets of Apple and Samsung, and they don't operate in Sri Lanka as payment service providers. But I don't think we have phone-based NFC payments. I'm not sure. I'm not sure whether our phones have NFC. Let me just see. Let's see whether some of our apps have. Let's see. No, they have QR code payments. They don't have NFC payments. So we are yet to get that, but our cards are now contactless, so we have that. So yeah, that is where we are. So I told you about the very important point of the infrastructure, right? And we are seeing worldwide a huge increase these are in billions, right? So like more than half the world's population, I think now have mobile phones. So that's a huge number, right? And that means that we can expand the digital financial services, because in order for digital financial services to work, there's no point in only me having the phone. People around me should be having the phone, and I should be able to send my money to their phones. And that is where this interoperable point comes, right? And that's why, things like CCAPS, SAFES, Lanka Pay, Lanka QR, Just Pay, all of these are interoperable systems, because there is no point in only me having a mobile wallet if the other person doesn't have the mobile wallet to receive it, right? And it's no point if we are on two unconnected networks where I can't connect you. It's the same with phones, right? So now we can call Dialog, Mobitel, whatever, but that is because that switch is there, right? Under the TRC, that switch is there to connect. Otherwise, only Dialog customers will be able to speak to other Dialog customers, right? It's because that switch is there only we can call Mobitel customers or Hutch customers, or telecom customers can call anyone. That that facility needs to be provided, right? Otherwise, we can't have that. And even IDD calling or roaming, international roaming is another thing. That interconnect, that switching has to happen when you go to, sometimes when you go to big countries, you will see the mobile operator that the roaming connects with changes, keep changing. One time you're with Vodafone, and next minute you're with Orange, whatever. You keep connecting to other. That is because that switch you have to. So that's a business connection as well. It's not just a tech connection. There is a business model connection there as well that makes sure that everyone is connected into that interoperable, interconnected system, right? So having these smartphones is one, it's like the basic step to make sure that everyone is on a standardized platform, right? If people don't have the smartphones, then we can't do this. Right, so back to fintech word itself, you can see that the word kind of became popular around 2000, not popular, it started around 2013, right? The word itself started around 2013. And sort of in 2013, this word was getting coined and getting picked up. And then it just kept getting popular and popular and popular because people are using it, right? Because more and more fintech is happening in the world. So this is a worldwide search. If you don't know what this is, there's something called Google Trends. So any word or any phrase, anything, you can type it in and see how many internet searches have been done. So this is worldwide. You can take it region, you can take Sri Lanka, you can sort of compare it with other terms, you can put it together with other terms and see how it is. And you can see how it has been searched, the level of interest over time, right? So this is what it says. It says level of interest, that is based on internet searches. So you can see that the level of interest is pretty sort of stable for the last 2-3 years, or last 2 years, yeah. So when we look at fintech companies, right? Now fintech companies, now what do you think of fintech companies? Now there was sort of official term, company that does fintech is called a fintech company, but if we take it sort of from the setup of a company, what sort of company would be a fintech company as opposed to not a fintech company? So a fintech company, generally when we call a company a fintech company, it's not a bank, right? It's not a bank. But now banks, especially in Sri Lanka and also abroad, banks have caught up, right? So banks are also doing a lot of fintech work. But when you call something a fintech, it is not a bank. It is a non-bank. It is a bank that has brought tech and finance knowledge together, and they're coming up with not banking services per se, some of them are, but mostly it is to sort of fine tune or improve the efficiency of some specific financial services, right? So you can see, so the word fintech was drawing a lot of money, right? It has gotten a lot of investment because this was seen as an area that there was huge demand. Now, how did that demand emerge? Going back to what we said, people got the infrastructure, people got the phones, people got the internet connections, people got the companies were giving e-commerce, right? People wanted to access their money better, right? But the banks weren't giving them the service because banks had to, post 2008. Other thing that happened was the Basel requirements and all of that changed, right? So you can't fool around now, right? It got really strict for the banks because it looked like the banks were fooling around. And then the Basel requirements, capital adequacy requirements, all of them, risk mitigation procedures, all of them changed quite a lot, right? So it got more difficult for banks, right? They had to sort of, they were forced on the stability path. Whereas this is on innovation. So this is on a changing path where you have to take risks, you have to make new investments, you have to try seeing how things work in a new way. So that is exactly the opposite of what banks had to do at that time, right? So a lot of the banks didn't have time to capture this change that was happening in the market, right? Instead, they were grappling with stability issues. And also the banks were fine with customers not having so much digital access and digital products because it didn't matter to them. Their money was already with the banks, right? That's when the fintech started coming through. And then because there was such a huge demand for it, and Silicon Valley also was getting a lot of money because of the tech boom, there was a lot of innovation, right? There was a lot of innovation that happened and a lot of venture capital money going there, a lot of investments. Fintech related, there are all these terms that come with the word startup. Have you ever heard the word startup? Have you heard of the word startup?
Yes.
Okay, what is a startup?
A company with a new business model or a new idea
Yeah.
starting with the support of venture capitals or something.
So the word startup is a very interesting word. So when we were studying, there was no such word as startup, right? They were businesses or entrepreneurs. They were just small businesses. They were just, every business has a beginning, right? But then after the rise of this internet, sort of post 2008 innovation, with the rise of the word innovation and all of that, the word startup started. So startups were considered even more agile, like more flexible, and they got a lot of venture capital funding, but they had the possibility of failing was sort of, it was taken for granted that there was this high risk of them failing as well. So you have words like tech startups, fintech startups. And then, of course, it is not only limited to tech. So anything that comes up with some innovation, if you go to Hatch, Hatch is, have you heard of Hatch in Colombo? So there's this place called Hatch in York Street, I think. So that's a startup incubator. So it helps these small companies, these small innovative companies to grow. They find them funding, they give them guidance, have a mentorship program. And then there are people, if you go to the Hatch website, there are companies there, they are having these eco-friendly slippers, these slippers that you wear on your feet. And all sorts of food and all these stuff. They're all now startups. Any new company becomes a startup sort of thing. So fintech companies are most startups, and they manage to draw in a lot of funds, right? Like huge amounts. So in 2019, $168 billion, right? So these are huge worldwide investments for fintech. And you can see that even the regulators started to join in, right? Even the banks started to join in, right? So we have UBS is, I think it's a Swiss bank. Banks also realize, okay, there's a lot of money going into startups, and startups are also making money because from the innovations that they're coming up with, they can make a lot of money that the bank's traditional model is not making. And they are like, hey, if we can acquire these companies that are making a lot of money, why not? And if this is the future, why not? Buy. So that's how banks actually started entering fintech, because they couldn't. They did, most of them didn't have resources or trained staff, staff who thought in that way to repurpose them or reassign them into fintech. So instead, many of them started buying up fintechs, and that's how they got that. That's one way to acquire the skill, right, and the capacity. Um, they bought those. They acquired those fintechs, right? So you have market value of big fintech companies rises to 1 trillion, right? So more than the largest bank. So it's sort of changing the financial industry, right? So this is something that banks need to understand, that there is this now new actor or new stakeholder who is growing in strength, because they are now with all their business, with people using their payment apps, their fund management systems, or anything, any services that they were providing, remittance services, they were making far more money. And the interesting part is they were focused on the retail, right? Fintechs are mainly focused on the retail. They go on volume, whereas banks go on value, like on big margins, right? Whereas these guys, small margins. So for the retail customer, it's cheaper. So that's why they leave the banks and they come to fintechs, because it's cheaper. They go on low margins and high volume, right? Because they use the internet and mobile apps, they can reach a much bigger market faster, because it's through the app store, right? So they don't have a big physical, like a headquarters or anything like that. This small company, they just reach those companies through the apps, right? Through the app store and the internet and online advertising and all of that, word of mouth, youth popularity and all of that. So it's a completely different business model, and so they have made a big mark, especially abroad. They have made a big mark. So then the governments and the central banks also started looking at the fintech sector, and a lot of changes have happened through this, where they have also encouraged fintech in their countries, right? Any questions so far? Before we go to the next section, let's take a 10-minute break and come. We'll come back at 4. Gavin, when did are you there?
Yeah, miss.
Okay. When did you join HSBC?
Last year, January, actually.
Right. So you're an MT, is it? Or a officer?
No, I'm actually working in the compliance department.
Right.
Is that?
Okay.
Yeah.
Yeah, you said that you were in compliance. So do you like the work there?
Well, it was supposed to be temporary, but then like with the situation and going on and everything, so I found it very convenient. That's the thing.
But y'all are working from home, or y'all now at the bank?
Still working from home.
Oh, still working from home?
Yeah, for the past 1 year, I've been working.
My gosh. So from the time you joined, you have been at home?
Yeah, just like 1 week or so, we had to go to office. After that, we work from home. So that's like it was very convenient, like during the time and.
Yeah, but now I suppose it'll be good to go to work. And
Yeah, exactly. But I think most probably like by March or something, they're planning back to office.
By March. So is this a HSBC global policy or?
Yeah, the global this thing. Global
All right. Right. So yeah, I heard even some of the other global companies also, it's the same. The staff globally, they have still not allowed them to go. Yeah, we have been going now since I think for a few months now. Yeah, I mean there are conveniences in both. Uh, yeah,
Going to office and
yeah,
both.
yeah. That's the. So we will start and get through. So far, is it clear what we've been discussing?
Yeah, I mean, all good. I just missed a few lectures. I had to go through it again.
Yeah, yeah. So if you have any questions, ask, because now this one, though I'm just talking, I will probably give you all a question to just sort of discuss, things like how fintech affected banks, that sort of thing. That's why I'm sort of giving this sort of just story. I'm giving the story of it
Yeah.
so that you all know. Uh, Right. We'll just proceed. The others will join if they are. I think it's recorded anyways. It's fine. Um, okay. Right. So we'll continue. So before we go into things like how to identify fintech and all of that, I'm just going to introduce some terms to you, and we will expand on this in the next few lectures. And now I told you that these are always changing and it's very different. Now, when I taught this lecture last year, some of these points hadn't developed so much, but now they have developed some more. So we'll probably spend a bit more time on artificial intelligence. RPA, robotic process automations. They're both artificial intelligence, big data, robotic process automation is kind of very connected. And then we'll spend a bit more time on blockchain because we central bank also completed a like industry level study on it. We also had a study on artificial intelligence as well. So we can discuss that in detail. So these are very new findings that we will be discussing. And also globally, the applications of these have changed over the past year. The knowledge and understanding has changed, so we can uh, we can discuss those. So some applications, this is a very high level diagram. I just put it here for simplicity, so that you have an idea of what fintech is, a bit more than payments. Fintech is not just payments, right? So payments, of course, was the first fintech application. It was the most popular because it was an area that everyone needed and had just not been addressed, right? It had not been addressed for about 30 years. After the credit card coming, for about 30 years, it had not been properly addressed. So that was the lowest hanging fruit when it came to applications. Um, so you have, when you take financial technology, you have two levels, right? You have the underlying technologies that are supporting uh, financial technology, and then you have the outcome, right? What we see, right? What the customers see, what is the product, right? So those are the two. That's why we have financial technology in the middle, and then the underlying technology is on top, and then you have the outcomes below, right? So things like artificial intelligence, machine learning, those are sort of those are advancements in the technologies that we already have. Because everything is getting innovated and advanced and upgraded, and people are finding new ways to do things faster and safer and in every possible way. And automation, the idea of automation itself has changed to where the robot is a more sort of a normal thing. It's no longer the robot is no longer like, you know, in our minds, it's this sort of metal human-like structure, but in practical purposes today, the robot is not a physical. There is nothing. There's so many robots who are not physically in existence, right? They are virtual. So the virtual world has sort of changed much of financial services as we know it. So those are blockchain again change the way not only financial services, a lot of other industries have been looking at their value chains and how businesses are done. So some of the popular outcomes of financial technology is we have things like crowdfunding platforms. So no longer does everyone need to go to a bank or a financial institution to get a loan. There are sort of other ways where you can, you know, go on the internet, set up a GoFundMe or something like that, and get more people to put in smaller amounts. So always you can see that there is this smaller amounts, this retail value thing coming up, right? The cheaper option. These are coming up, and so crowdfunding, mobile payments we've discussed, Robo Advisors. That means like things like investment banking. You don't need humans so much now. They use artificial intelligence. They have things like Robo Advisors, and then you have things like InsurTech and RegTech, right? So then there are also other ways that fintech gets used, like open banking, there's peer-to-peer lending, credit scoring. These are all sort of fintech applications, transaction delivery, small ticket loans. Or you can see that there's this again, the small measure, right? We will be discussing open banking in length. Digital wallets, that is what we have, all these freebies, solos, they're all digital wallets. Asset management, digital banking, now more and more banks, even in Sri Lanka, we have digital banking. And then there's something called digital banks, right? Not digital banking, but digital banks. We'll discuss them as well. And then we have digital insurance, right? So let's first start with the lower hanging fruit. Let me go to the right. So what is a payment fintech, right? These are all random pictures from the internet, right? As I said, payments is one of the first areas to be addressed, right? And then payment fintechs mostly address the retail customer access, right? Because retail customers didn't have a way to access the payment end of the value chain, right? They couldn't, if they wanted to make a payment, they either had to use the card or cash, right? Otherwise, they didn't have an option, right? If to pay digitally. So mobile payment methods such as e-money, payment apps, payment gateways, and then common payment fintechs, right? So now what we see is, now initially we all saw this one, right? So if we have the card, we get this, we still get this, right? So we fill in all the card details, and then we review the order and we go through. But now we don't have to do that, right? Now PayPal was one of the first, right? So PayPal, they said, okay, none of these details are there. You already have the PayPal details are already saved. So you just say pay through PayPal, and then it just goes, PayPal gives you this option that you have saved in it, and then the payment goes through. So you don't have to fill any of this. So this is one of the first innovations. So you don't have to release your card details, your billing details, nothing do you have to release to the merchant, right? Otherwise, in a card transaction, there's a merchant mandate where the merchant is told, okay, don't share these details with anyone else. But here, you don't have to share the details with anyone. It's already, you don't have to share your credit card details, nothing. You just have to pay through PayPal. Now that was one of the first this thing of masking the customer identity and the customer's financial details. So this is one very important innovation, because this allowed small scale industries, small scale merchants um, to join the e-commerce trend, right? So like people don't mind, if we go to like a reputed company website, we might not mind putting all our card details, but things, this is why I said this is why PayPal and eBay work together so well, because in eBay it was full of, it's like Daras. So if you haven't shopped on eBay, it's like Daras, where small merchants, it's a platform for all of them to come and sell their goods. So but the connection, the sale goes through the information goes to the small merchant as well. So therefore, if you don't trust a small merchant, the small merchant might not get the sale because the person doesn't want to pay using their card. So when they have PayPal, then the customer doesn't have that risk, and the money also goes to the merchant properly. So that is why PayPal was so successful, because it really addressed a market need that the credit cards had not been able to address. So then you have subsequently, now if you take our apps, if you look at your Solo app or whichever app that you have, iPay, Free Me, any of those apps, all of them, you can see now you can directly pay all these merchants without any problem. Utility bills, phone bills, um, taxes, anything, you can just directly pay from your phone, and you can save new billers as well. And then that's it. And this the money goes through, right? And then the other options are again the same. These are all these other options, and then you have Lanka QR, which is also masking information, right? You don't have to make if we make a CEFS transaction, we have to ask the merchant. If we make a CEFS transaction to the merchant, we have to ask the merchant for the merchant's bank account number, name, bank branch, depending on the format. Now here we don't have to do that. We just have to scan the QR code, right? Now imagine if we wanted to make an interbank transfer, and every customer was asking the merchant for their bank this thing and typing all the bank account numbers, so it doesn't work, right? So that inconvenience is now done away with by using the QR code. So QR code already has that information encrypted, and all that we're doing is we can't see it, but the app is reading it and sending the message, securely sending the message to the bank and Lanka Pay to secure to process, right? Now that is why that is called a fintech innovation, right? It's using technology, the encryption, the QR code, the mobile connectivity to access the bank account details, right? And send the money across. Because the final thing is everyone just wants the money to go from point A to point B. We have to remember that. The bottom line is that the faster we can do it, the least hassle, the least security issues, the least fraud risk, that is the way to get a mobile payment done. So if you can get all of those things done, then you're fine, right? You can use technology. Okay, so the interface is simplified. So crowdfunding. Have you all heard of the word crowdfunding? Have you heard of the word crowdfunding? Have you heard of GoFundMe or Kickstarter? Or any of these? So just go on the internet, on Facebook also, there's Kickstarter. Of course, you can, very often you get Kickstarter advertisements. So these are, crowdfunding is is the use of small amounts of capital from a large number of individuals to finance a new business venture, right? So crowdfunding makes use of the easy accessibility of vast networks of people through social media and crowdfunding websites to bring investors and entrepreneurs together, with the potential to increase entrepreneurship by expanding the pool of investors beyond the traditional circle of owners, relatives, and venture capitalists, right? So, what this means is, now usually in a business, people, they, if they want to start a business, they need some capital. They will go to their parents, or they will look at their own savings accounts. They will come to their banks or go to venture capitalists, people who will take a bit more risk, or finance institution or finance companies are specifically set up for that purpose, right? Its name is financing. It's for financing. So they will go to those. Those are the traditional places where people go to get capital, right? But it's not easy. You all working in banks know how difficult it is for people to get loans and financing for businesses, right? Now the common phrase is, you have to have money to get money. You have to get a loan. You have to first show that you have money, right? You shouldn't show that you actually don't have money, and that is the reason that you need a loan. So in that environment, with social media, with the internet, people realized, people started reaching out, right? They went to the masses and they said, okay, would you like to invest? And then there are a lot of people who would like to invest in companies, but they don't have a lot of capital. They don't have enough capital to be venture capitalists, right? But they have a little money that they can put in, and they are sometimes happy to help them. Most of them, they have some good products, some eco-friendly or something, some good cause. So these, with social media, you can reach vast amounts of people, and so everyone will put, I don't know, $10, $15, whatever, and then, but you can get a lot of money, and then each person gets either profit or some sort of interest or something, or sometimes it's just charity, right? And Now, a lot of Kickstarter product, if you go to Kickstarter, you can see there's a lot of products. If you are funded, then you can pre-order at a discounted rate or things like that, right? And so that is one thing where they use digital technology, internet, social media, platforms, and they have created these platforms, Kickstarter, GoFundMe, all of those are platforms. GoFundMe, people even fund me if I go ask for funds for like ships and all those things as well. And I think you'd pay a small amount to the platform, like a percentage, and then you set a target, and sometimes you can exceed this target as well. And yeah, and that's how the funding happens. So you have different models. So you have reward-based crowdfunding. So there's a commercial product, and then there's some reward based on the pre-sale or something like that, right? And you have donation-based crowdfunding. So that is just a donation. Then you had crowd investing, for startups, and then you get profit in return. And then you get crowd lending, right? So you're lending in this point, right? So you get an interest for lending, for giving your money. And then you have invoice trading, right? So they get a discount. So that is roughly what crowdfunding is. Any questions on that? Now, there are some companies, they don't, I mean, they must be having venture capital funding as well, but some of them, they directly come to things like Kickstarter and get their funding sorted, and you get some interesting products there if you go to things like Kickstarter. and some of them are successful. You can see their stories. It's an interesting concept, and some people just like it more than going to banks because it's more flexible, because it's sort of smaller financing. You know, the risk of losing it is also, people can afford to lose it, and also there's no one sort of coming behind you to get it. But of course, for your integrity, I think it's important you do it correctly and don't swindle the money, because I think there are some safeguards in those platforms, so that people don't swindle money. Basically, you know, they don't take the money and run off, because that risk is also there. Yeah. Just if you haven't seen Kickstarter. Go here. So you can see it says 43 fundings, projects funded. You can read all these, all sorts of things are there, and it's quite interesting actually. You should go and check this one out. Right. Right, cloud lending. So crowd lending, it can happen for consumer purposes. So again, just like a bank, business, real estate. So the important point here for us to understand as bankers is that there is an alternative ecosystem now. There's a well-established alternative uh, happening at the moment, right? So we have to, as bankers now, we have to start responding, right? We can't forever take for granted, oh, we are bankers, we are safer, we are better, everyone is going to come to us. No, there are now in US and all of that, there are a lot of people who have shifted, right? So if people are shifting, that means you are losing. So for every Kickstarter based crowdfunding, that means a bank or a finance company has lost some business, right? That is important to remember. So the front of office people, the loan officers, they have to understand these new ways of lending, how people source funds, and adapt to these. Probably have new business models. You see it in the US and those countries. The banks are having new business models as well. So these are very important to understand, right? And also adapt your business accordingly. Right. Robo Advisory. Robo Advisory is an important thing, right? So when it comes, this is mainly for investment and financial planning, right? So in Sri Lanka, certain banks provide financial planning, investment advisory for bigger clients at least. In countries like in the US, this is pretty common, right? A lot of people invest whatever money they have, and you have a relationship manager, and a lot of people have wealth managers. When people, especially because there are a lot of high paid jobs. So if you're in like the Silicon Valley, or if you're in New York in the financial district, if you're in Hollywood, there are a lot of places where, if you're in the tech industry, not only Silicon Valley, Seattle, wherever, or if you're in research and all this robotics and pharmaceutical research and all. There's so many points in those countries that you can earn a lot of money, right? So, and these are normal professionals who earn a lot of money. So then they want to invest their money without them just um, sitting in the bank. So and they don't have time to manage their money so much. So I mean, in Sri Lanka also you have companies that do wealth management, but here this is far more popular. Like it's very common to have financial advisors and wealth managers. So people can obviously do it by themselves, right? You can have a financial advisor. Of course, you have to pay the financial advice, obviously. But then in the middle, people realized, oh, we can come up with this thing called the Robo Advisor, right? Let me see whether this YouTube link works. I forgot to check this one out.
If you want to sell online, make sure you stand out. Go to Wix.
By now, you've probably heard about Robo
Okay.
Advisors or seen their commercials on TV. They're not really robots. They're software platforms that manage your investments powered by algorithms, but made by humans, really smart humans. Accounts managed by Robo Advisors require less money to start and offer lower cost investment products. They customize your portfolios by examining your personal data and your investment goals. Online investment advice was born in the late 1990s, but Robo Advisors really sprung on the scene in 2010, a couple of years after the 2008 recession. There are now more than 200 of them, managing over $70 billion. That may sound impressive, but it's not a lot considering the $32 trillion of investable assets currently in the United States. But time is on Robo Advisors' side, and it's all thanks to demographics. Baby boomers and their parents, the silent generation, currently make up about 1/3 of the U.S. population. However, they control about 83% of U.S. net wealth. These generations have mostly relied on human investing professionals and financial advisors to help them decide what to do with all that money. But the financial advisory business is facing a transformational change. You see, those 83 million boomers and older folks who control so much wealth, they'll peak as the wealthiest demographic in the next 15 years. Generation X will become the wealthiest demographic, amassing $37 trillion by 2030. Millennials will have about $20 trillion by then. But these younger generations may be less likely to use financial advisors and invest like their parents and grandparents. A lot of them lost trust in the financial system after the 2008 recession, and many don't see why they should pay another person to manage their money when technology can do it cheaper and with more accuracy. That's a real threat to human financial advisors who are already facing their clients getting older, with younger generations less inclined to hire them. In fact, 66% of children fire their parents' financial advisor after they receive an inheritance. Now, big investing firms have seen this coming, so they've been busy building or buying their own robo-advisor platforms, trying to catch this growing wave of younger digital investors. Studies say the robo-advisor, or the digital advice market as they call it, will swell to $500 billion by 2020. And traditional investing firms like Fidelity, Schwab, and Vanguard, they'll control 2/3 of all assets in that market, a huge chunk. Currently, the typical customer is between 35 and 45 years old and has an average account balance between $20,000 and $100,000. That's a lot less money than financial advisors are used to managing. So, is there still a place for people in a digital advisor world? Well, probably, if they learn to use robo technology as part of their services. You see, robo advisors have yet to experience a true bear market. They haven't had panicked clients watch their savings and investments circle the drain. That day will come, it always does, and the need for a real person with expertise on the other end of the phone will be there. But who or what will be on the other end of that line is the multi-trillion-dollar question facing investors, advisors, and money management companies around the world.
So you must have now in this video you must have heard some words that we heard before in the lecture today. So they mentioned the 2008 recession several times, which is the financial crisis, right? And that led to a recession. So this is why I said the 2008 financial crisis is really important as bankers to understand. So read up, as you have, if you don't already know about it. There are some films on it, like Wolf of Wall Street, I think, and there's few other films on the 2008 financial crisis as well. There are books written on it. It's quite a phenomenon. If you weren't working at that time, it will be good to watch these and read up on this, because it really changed so much of the financial industry, not only in terms of products and services, in terms of banking procedures, as I said, the capital asset requirement, the bank supervisory procedures globally. It changed everything globally. Because also what was very clear was how interconnected everything was. So everyone had to standardize. Because everyone was running on systems, and there were a lot of foreign exposures. So 2008 financial crisis was very important. Again, we saw 2008 was when the first Robo Advisor was created. We saw when we were discussing at the beginning of this lecture. And by 2010 it really picked up, as this video showed, right? So and again, another point this video raised was the smaller balancers that the new generations are having. So they are not, no longer are we talking about people with large balances, right? I mean, those people will be there, but they will be different, right? So the new generations, they want to manage money on their own. But sometimes it's difficult. Practically, it's difficult, though you might be quite smart, but you don't have time, because your chosen job is not managing money. Your chosen job is doing something that you like, right? So then they might not be ready to pay a financial advisor. So this is when the robo advisor comes in. And it's quite interesting how now so when you have smaller balances, it makes, like, just as I said before, so the retail, right? The retail values, the smaller values, right? Everyone wants to pay less, everyone saves less, everything is less, but so it's going on volumes, right? So when you're going on volumes, you need to figure out your business model so that you get a profit, right? That's really important. So sometimes paying a financial advisor might not work, because you're already working on a very small capital, right? So a percentage of that won't be enough for the financial advisor, unless the financial advisor also manages a lot of accounts, right? So that is when these automated processes become helpful. And a lot of these, just like banks adopting fintech and acquiring fintechs, these investment banks, even like the Sri Lankan investment banks, Sri Lankan banks that are doing advisory services, they are adopting robo advisors. So robo advisors a financial advisor will use their experience, right? Their experience and knowledge from whatever courses that they do, CFA, CIMA, all of that, and give the advice, right? Now, the robo advisor most of the time uses artificial intelligence and automated and machine learning, right? So they will look at patterns. They will look at patterns about, the interest rates, the returns. They will look at patterns of human behavior, patterns of investment, the securities behavior, the loan behavior. They will look at all the behaviors, and then based on it, they will advise, right? When we discuss artificial intelligence, we will discuss the pros and cons of robo advisory. Now, let me just go to this article and see what's there. Right, so this is 2020 robo advisors, right? So in this article also you have all the words that you want. It's very simply described here. So this is an automated algorithm-based approach on building investment portfolios, right, on behalf of customers with little to no human intervention, right? So little to no human intervention means there is, when we talk about artificial intelligence, we will see this one, where sometimes you need some level of human intervention to get it right, because sometimes there could be biases when the robo is making decisions, right? So it enables investors, especially new and inexperienced ones, to invest their money in a simple, automated, hassle-free manner at a low cost, right? So simple, automated, hassle-free manner at a low cost. So now this is something banks have to now recognize, right? Because the new customers are looking for simple, hassle-free. We will leave aside automated. They want simple, hassle-free, and at a low cost. So how do banks respond to this, right? How can we use, one way to keep the cost low is going digital, but then what is the role that the human can play, right? Where does the human come in to either help, the human can either come to help the inexperienced one use the robo advisors, or the humans can get new skills as to developing good robo advisors, right? Because so many companies will be offering robo advisors, so you need to make sure that your robo advisor is better than everyone else's, right? So it's like a fight of the robots, right? um, so um, yeah, so there are all these are foreign ones, obviously. Um, so read up on these so that we know. And even in Sri Lanka, many of the banks are starting to use AI based systems. So in the future, you will have these in your banks as well. So it's better for you to find out, right? So this one is Schwab, right? So Schwab, what is this one? So Charles Schwab is like this well established. The reason I put Schwab is because it's specialized in this investment banking, right? So it helps people. It's a wealth management bank, and so it basically specializes in managing people's wealth, and it has so many financial advisors. And now it provides people with the option of robo advisory. Like when you go to Charles Schwab, they will say, "Oh, okay, I can help you." The financial advisor will say all that. They'll say, "Oh, we have this robo advice as well. If you like, that is this cost and blah blah." You will have you. They give that option directly because they know they'd rather keep the customer with the robo advisor than lose the customer altogether. So this is the sort of uh, the, this is how banks should respond to the changing environments without saying, oh, always do, without always doing the same thing all the time. When you see the market is changing, when you see the technology is changing, you must learn to adapt and change your approach so that you still have your customers and can grow more customers. And so if you are kind of early in the game, then you get more customers coming in. And especially when you have that experience, then you have a better capability of correcting your models as well, your so algorithms, you can correct them better because you already have that experience in improving them. So InsurTech is using technology for insurance again to cut costs and increase efficiency, right? So this is the sort of the theme of fintech, is basically increasing efficiency and lowering costs and reaching more customers through digital means, right? Of course, the challenges of insurance, and the reason I bring insurtech is we it is a part of financial services. It is a financial services that is often kind of ignored. But again, I think once insurance becomes more accessible, even in Sri Lanka, people will use it more. Insurance is not used so much. It's like people use insurance only if the law tells, like if you have. If you have a car, you have to have insurance, or for workman's compensation, you will have insurance, or it's very most lot of people don't use insurance unless they're kind of forced by some insurance agent. So if insurance has a better business model that is more accessible, then people will use it more, right? I mean, in Sri Lanka, most of the time people don't see the cost benefit of insurance. So, so that market doesn't clear properly. So I think using technology, that market will be able to clear better. So what does market clearing mean? Can someone tell me what market clearing is? Anyone, when you studied microeconomics? So clearing is basically when demand and supply properly meet, right? So that is the clearing point. You will see, you must have learned that when demand and supply properly meet, and so it has to meet at the right. So that is the price. So most of the time, if people feel it's too expensive and it's not worth, that means the market is not, and people are like kind of buying them because their relatives are insurance agents, or because they're forced by law or something like that. That means it's not clearing at a proper free market level, right? um, Another challenge for startups is that the way insurance is worldwide, the way it's done is insurance gets underwritten. Like one insurance company is insured by another insurance company. Like, a lot of time you must have heard things like Lloyd's. They are very famous underwriters. So even if you're a startup doing insurtech, you need these traditional big firms to underwrite, and then your cost model becomes a little difficult again. RegTech. Now, this is important, especially for compliance purposes. Have you all heard of RegTech? Have you heard of RegTech? So RegTech is our systems. They also fall into fintech. Um, is the management of regulatory processes within the financial industry through technology, right? Main functions of RegTech include regulatory monitoring, reporting, and compliance, right? So automatically these systems, they will alert. Now for FIU purposes, there's a lot of RegTech already there, right? So RegTech uses technologies such as advanced analytics, robotic process automation, cognitive computing, and the cloud to achieve regulatory compliance and outcomes more efficiently and effectively, right? So RegTech is using all the technologies that we talked about before, analytics, AI, robotics, to identify patterns. For fraud, you can identify patterns. For AML, CFT, you can identify patterns. And then any compliance requirements, let's say capital requirements, the cutoff levels, all those you can put this into automate, and then sometimes you can extend it where the regulator themselves see these outcomes directly, where you don't have to specifically then upload it into another system. This system itself will link to the system where you have to report to the regulator. Right. Any questions on any of these? Any questions? If there are no questions, we can. Yeah. Sorry. Yeah.
Madam, what is blockchain technology?
Yeah, we'll come to that. I will have I will have a fairly detailed presentation on blockchain. So very simply, blockchain is a technology. It was a technology that Bitcoin was using. So it it has an audit trail. So now, for instance, when we write something, we can delete it, no, word or whatever, and then we don't save it, and then it goes out, right? So if you want to commit a fraud or whatever, then we can do things like that. But for blockchain, it's not like that. Once you have done anything, it gets recorded in the blockchain. And so that is a very powerful technology, especially for financial services. So we will discuss that in detail and how blockchain is used for fintech as well. Okay, so that's why I didn't touch on it, because it's different. So artificial intelligence, machine learning, big data, robotic process automation, those are all of the same family. That's why I kind of touched on them, but I will expand that knowledge on an artificial intelligence topic. And blockchain is different to that. I mean, they also have some automated processes, but the blockchain is different to that. So I will discuss it separately. Okay. Because I don't want to confuse you. It's easier to understand the robotic processing than blockchain immediately. I will do that. Anything else? No. Right. Let me. Right. Let me. Um, let's take about a 2-3 minute break, just to sort of, I need to plug in my computer mainly. And I'll start the next one on how to identify fintech. And we can, then next lecture, we will have, what do we have for the next lectures? Let's see what we have for the next lectures. Next lectures are more theory. Just wondering when I should teach all. Because last time I didn't teach blockchain and artificial intelligence in big detail, because it we just had some basic. I mean, it was sort of covered in a very basic level. Let me see where. and open banking. So last time I had taught artificial intelligence and blockchain at the very end, and wondering with the course of discussion, because next time I have some like theory on fintech innovations and disruptive innovations. I'm just with the flow of our conversation. I'm just wondering whether we should take artificial intelligence and blockchain a little earlier. Let's see. I can move the last lecture forward and expand on it. I'll see how it goes, because as I said, this area is very dynamic. So I'm not teaching exactly what I taught last time. So I'm constantly moving things around to make it more timely and relevant, and because with the level of use in the environment, um, I keep changing that one. So yeah, just based on the conversations, how relevant they are. Because the other thing what we have to remember is sometimes something might be sound really relevant at some point, but then they could lose their relevance very fast. But something else that didn't look very important has suddenly really emerged and is now, for instance, things like AI and robo processing, it was there, but it wasn't global. But now, globally, we have regulations, and in a very short period of time, the financial industry globally has responded to artificial intelligence and robotics. Before, it was just something that investment banks and a few others were using. So now suddenly it has blown up. So yeah, so that's why I thought it should it should have a more like a bigger this thing. So right, so what I'm going to do is I will sorry, I'm not presenting. I will present this one to you. Teach you what? Right. Oh, sorry. I wanted to stop. I wanted to plug in my computer. Give me a sec. Right. I promised to take a break, but let's carry through. Right. Right. Okay. Wait, where is my updated one? I need to change this thing. Sorry. Right. Same. So this is just continuing from the last lecture. So types of fintechs, right? types of fintechs, and this is basically what I want to do is help you all identify. Now we learned, okay, now what are the areas that there is underlying technologies like AI, blockchain, and then there are outcomes, right? Like what we see, payment platforms, crowdfunding, insurtech, those are all outcomes that we see, right? Now we want to add how fintech works, right? So how do we identify something as a fintech, right? Now, this is like a small little cartoon that was there. So how do we identify fintech from traditional tech, right? So there is this cartoon says, now this person is with a pile of paper. Now this cartoon then coming and asking, probably the bank manager is coming and asking someone who is processing. They're saying, do you think it's a stretch to call our onboarding process real time? Right? So this is something to do with the know your customer processes that banks do. You all know what onboarding is. Y'all are working front office as well, sign compliance as well. And so this is what it means, right? Like sometimes people use words, but it's not really that, right? So if you're having a lot of papers and if you can do it really fast, you can probably call it real time, but what does it really mean? And how do you use these words? It's important. Now, that's why sometimes people will say, oh, we are doing fintech, but it's not fintech, it's just using technology, right? So, how do we identify fintech from traditional tech, right? So, how do we distinguish this, right? So let's look at one of the old diagrams, right? Which is shopping with a card, right? Now, this is pre-fintech, shopping with a card, right? So you have the the customer gives the card. It could be even the Lanka QR here. And then it goes to the bank, right? And so this is the acquiring bank. So this is the credit card process, right? We saw this process, I think, the third lecture, not the third lecture, the second lecture, I think. And then what happens? The message goes to the card network, right? Visa Master. And then Visa Master sends this, so Visa Master checks, okay, is this card properly authenticated, authorized, is this okay? And then it sends the message to this bank saying this person wants to pay, this card holder wants to pay this merchant this amount, do they have enough money? Then the bank system quickly checks and says, okay, this card which is linked to this account or this card which is linked to this credit account does have money. Okay, so then the card network sends it through. So this card network here is doing the similar function as Lanka Clear here, right? They are sending the message through, right? So these are all card network infrastructure, right? That's going. So then the message goes back. Acquiring bank, who has given this POS to the merchant, says, okay, you can proceed with the payment, and then the slip comes out, right? And then the fund flow, later what happens is the issuing bank, which is the customers, just a minute. Sorry. So where were we? Right. So the fund flow, 1 day, 2 days after whatever the arrangement is between the card networks and the banks, um, the issuing bank, that is the customer's bank who has issued the card, right? That's why it's called the issuing bank, sends the money to the acquiring bank, probably through a batch file, maybe a slips or a SIFs or RTGS transaction. They can send the money through, right? So the money will go, and then whatever visa, whatever the MDR will get split accordingly, and that payments will go. But here the money goes to the merchant's account, right? So this is the original transaction, right? Then now what does this fintech do, right? Now this, we can take this off. We don't want the POS machine anymore. Instead, we are using the phone. The card has been taken off. Sorry, not the POS machine. The card has been taken off. Instead, now this is something like Apple Pay. Right? This is something like Apple Pay. Right? The card is already now included in the mobile wallet. Right? Now you can see small. It's quite small here. The Visa, Master things are there. Now the custom is using their biometrics to authenticate. And now the card has been taken out of the picture. Right? The customer doesn't have to carry the card anymore. The customer doesn't have to type the PIN number anymore. Now, actually, in Sri Lanka, it's not mandated. In many countries, now it's mandated. Chip and PIN. We have chip, but we have not mandated the PIN, right? We are using a different authentication method for chip and PIN. For the chip, we use EMB core, but we don't use the PIN, right? But abroad, now you have to use the PIN. So now this is the fintech part, right? So the old thing is still the same, right? The customer facing end has changed. Now it's easier for the customer, right? It's the process has just become simpler for the customer. So the customer doesn't need the card, and even if customers all stop using cards, then this machine also can change. It just needs a NFC reader, right? So this also can change. If everyone moves to this, then we can get rid of this one and also this bulky machine, right? So that is fintech. Now they are using the technology of the phone and getting the getting the same transaction. The rails are still the same, right? Or you can use interbank. Now, if they're not using card, now interesting thing was Apple, though it was considered a big Apple Pay, though it was considered a great like sort of innovation. It was running on card rails, right? The card network rails, which is about 1960s, 1970s. It was pretty old. So it was integrating into the card network. Now that's another interesting thing about cards, which is the card networks have been probably the most versatile, right? That's why it has managed to stay relevant for now more than 50 years, right? It has managed to stay like the most versatile payment instrument for over 50 years because they keep changing their technology, right? The technology is very safe, and they have a lot of ways to catch fraud, minimize fraud, a lot of ways to ensure that the customers don't lose money. They also have been updating their front ends, right? Not the back end. The back end is pretty old, but the front end, so that when NFC came, they were able to change to NFC. When the iPhone came and Apple Pay wanted to, that they were able to have a digital token, right? There is now MasterCard has tokenization. So it's a digital token that gets transferred through. So we'll probably, I haven't talked about the digital token. Probably add the digital token. That'll be interesting for you to know. This area has a lot of new things, and in Sri Lanka, we are slightly behind in using a lot of the technologies for various reasons. Mainly because of the market. I mean, the customers, we don't have a big customer market, like we don't have a lot, we don't have very demanding customers, simply put. Even if when new technologies comes, they are not so bothered about it, you know. So with that, it becomes difficult to move ahead. Now, now most with COVID and all, people start using cards and QR codes. So the benefits of those, because it's not only the convenience and efficiency, there are also benefits in using these systems, like money going directly into the bank account, the real-time settlement and all of that. But yeah, so I think we like both sides. So when the market is not very demanding, there isn't a lot of incentive to innovate. So in Sri Lanka, a lot of the innovations have been either pushed by the regulator or a few companies or banks, and then that's how people have changed their ways of doing things. Otherwise, they most of the time they tend to just wait with. It's difficult to change payment habits. I mean, globally that's the case. In Sri Lanka also, there isn't much demand. And also the problem is, if there isn't much demand, there isn't much incentive, because everything is an investment. You have to make an investment, right? These things don't come free, or it's not simple. Like if you want to make the mobile NFC app, then you need to do the relevant integrations and the security checks and all the, the we learned in compliance what you have to comply in the minimum compliance guideline and all of that. So you have to comply with all of them. So then if there has to be a cost benefit. Right. So this was where the fintech is. Now, if you take shopping online, right? Take it a simple example here. So initially we have the internet payment gateway, right? You have the online store, internet payment gateway. It's also going through cards, right? So the same thing happens. The bank gives the internet payment gateway and it goes through, right? Now you can go through a mobile app, a payment service provider, right? With using, now it's going back to the same place, right? So the back end in all these are the same. It's the front end that is changing, right? The front end is changing. One, the way the customer deals with it, right? Now, for instance, now e-channeling, now I use Freeme to pay for e-channeling. I used to pay by card, but now I can't be bothered typing in all those information. So I use Freeme, right? Now, sometimes you might use Vishwa. Now, Vishwa is, of course, internet payment gateway. You have several options when you go on Freeme. If you go on a lot of these, not only e-channeling, a lot of these shops, you can pay through your mobile app now, right? You don't need to pull your card out. You don't need to type in all those words. You don't need to share all that information with the merchant. You can just type in your phone number and it connects to your mobile app, right? It's a just pay transaction. So yeah, and you have, then this is the fintech, right? There could be a third party payment service provider here as well. So instead of getting, now under the regulations, you will remember we allowed internet payment gateways to be given by a financial, internet payment gateways to be given by third parties like WebEx or Pay Here, right? So when these guys come again, the merchant doesn't have to get the IPG from the bank, right? The IPG is expensive when you take it from the bank, but the payment service provider will get an IPG, get a lot of merchants, right? Again, now we have the cost thing coming in, right? So the merchants can't afford a single IPG, or they can't do the required technological developments. So instead, the payment service provider comes in, gets an IPG connection, and then does the required technical developments to connect many merchants, right? So then the payment service provider gets small amounts from many merchants, right? So then that is profitable for him, and the bank also gets the payment. I mean, obviously it's not the same one IPG model, it will be a different model, but the bank is also accessing more merchants, right? Without having to go and find individual merchants. The payment service provider, third party, is now doing their job. They are going and getting more merchants, and they are funneling in or channeling in those merchants into the bank's IPG, right? So that is how they are using technology to get more customers or more merchants to come and use the bank's financial services. Now that is how fintech works. And then of course you can see the front leg is the same. And the back end is again the same. Because this is equal to this or this. It is an interface. These are all interfaces to connect to the bank, to the bank's systems, to see how much money does that person have in their account, right? You can access it through the card. So in the card, they have the customer's relevant details, like the credit card number, which is indexed to the bank account. Or in this, again, the credit card in the mobile app, again, it's indexed to the card account, right? So it's the same thing. Now this also IPG, you will use whichever form. Now here again, you use whichever form, and yeah, and then you access the bank, right? It's just simpler ways, faster ways, and sometimes safer ways, right? Now the reason, as I said, the reason I use the freebie option is because I don't have to type in all my details. I just need to give my phone number, and then the amount goes through, right? So it's much faster and it's complete. Yeah. So again, another fintech innovation is the national card scheme, right? So here, what is happening here, right? In the national card scheme, we have what usually happens is, this is going to the international card network, right? So this Visa, Master. In the national card scheme, what we are doing is, we don't go through the international card network. We are going directly to Lakapay, right? So the instrument is the card, right? They're using the card as the instrument, but it's taking a very similar flow as the other interbank transfer. So it's a local transaction. So here what happens is, it goes outside the country and comes back in, right? The message goes outside the country and comes back in, right? So we have to make a foreign exchange payment to these guys because they are based outside. But here, we don't have to do that because it's going through the LankaPay network, right? So this is the message flow. The message flows like this for a local transaction. Now, when it is where the fintech comes in is here the system will identify, is this a local transaction or a foreign transaction, right? If it is it, have I taken my LankaPay card and gone abroad, right? Or am I paying some foreign party, like I'm paying some foreign company, like a company I'm purchasing, I'm paying for rooms in a foreign country, right? Online. So then it will identify the transaction and then it will immediately route it to JCB. JCB is like Visa Master. It will route it to the foreign network, right? The overseas, this one, the international network, because the acquirer is a foreign or an overseas bank, right? So it's not a local bank in the LankaPay network, it is an overseas bank, right? So when they pick this one up, then it routes it into the JCB network. Then this process follows through. It goes into from JCB. JCB sends the message to LankaPay. LankaPay sends the message to the issuing bank, and then it goes through, right? Because LankaPay is the network for the LankaPay system, right? So it has connected to the foreign, for the foreign leg, it is connected to JCB, right? Otherwise, it just comes through. Any questions so far? Any questions? Is that clear? Do you understand what it is to have a fintech? Do you understand what it means to have a fintech? You might think, oh, it's very redundant, or it's why we can just go like this. But here, this is the cost, right? Remember, this is the cost factor. Mainly the cost factor and the fact that banks, when a bank, now IPG, if it's given by the bank, then the bank connecting directly to the bank, you're now directly connected to the bank system, right? It's high risk. So the merchant has to do a lot of developments, make sure that it doesn't go and create some mess in the bank system, right? And like where the systems have to crash. So all these IPG providers, they are PCI DSS certified, right? They are using all the international, they are compliant with international standards. So security standards and data protection standards. So therefore, it's safe for the bank to connect to them. And then from the merchant side, they will have a minimum, sort of almost like a plugin. It's like a platform, right? But it's safe. The safety issue is resolved here, right? So most of the time, what happens in fintech is, with IT, there are a lot of risks involved, right? Hacking being one of the main risks. Then the standardization. So system to connect, it needs to be standardized, right? So if you're going to connect into a very sort of advanced system, a complex system that is very secure, then you need to match that, right? So you both need to match. So if they don't match, you can't connect. You pose a big risk to the advanced system. So because of that, these guys come to resolve the uncertainty and the risk of that connection, right? So they are coming in as a third party and resolving that problem. And when they resolve that problem, they get paid, right? They will get like a charge or a fee or a percentage or something like that for resolving that mismatch. There is a mismatch between what the merchant can afford to develop and what the bank requires. So they resolve that mismatch and that is their business model, right? So that is what you had to crux of what fintech solves. So it may look like they are just duplicating work, but they're not. They are resolving a problem that is unseen in this picture, right? So the model will look like, oh, it's just duplicating work, but it's not. It is resolving a cost issue and a risk issue, right? So when you're paying with Just Pay also, now you know we spoke about Just Pay. And in Just Pay, Just Pay itself is a fintech solution, right? So we discussed this before. Instead of having to ask the merchant their phone numbers and their sort of account details. Here, the customer, all they need to do is they need to give their phone number, and then the merchant is connected to their bank, and then the message goes through just via the phone number, right? Just the phone number is given, and then that whole process goes through. Now, otherwise, if you are going to pay in a shop, as I mentioned earlier, if everyone goes to ask for all these details, it's not going to happen. People are not going to use this any digital payment method, right? They will just use cash. If it's too inconvenient, they're going to just use cash, and they're going to make mistakes, and then the money is going to go elsewhere. Here, you just ask for the phone number, and then you get a message to your phone saying proceed or something, and you just proceed. Lanka Pay online payment platform. Again, what is the fintech here? It is the access, right? It's the front end. Now you'll always see it is front end or very close to the front end, very close to the customer end, that the innovation happens, right? Again, here, instead of going to the bank and filling the slips, customs, they pull the data, right? So they will pull from your tin, they will pull some relevant data. It is linked to your tin. And then, not in customs, in IRD, it's linked to your tin. Here, you put the relevant details. And I think they pull in some information as well. And then you can just complete it without having to, so you don't have to make a CEFS transactions to customs. And one convenience is reconciliation. Now just imagine if everyone starts making CEFS transactions to customs, millions and billions of rupees, that becomes a problem, right? Because if the customer doesn't put the relevant details, and also it doesn't get recorded in the customs end. Now here, what happens is we directly put all our identification numbers of the customs reference numbers, company code, all the information is there. So it directly goes into the customs accounts, right? It gets planted there, and customs can see. Now you can see the messages are going to the customs bank as well. So the money is also going. The messages are also going to customs via LPOP and saying, okay, this person has paid. And then once that alert is there, then the exporter or the importer can proceed because it's already logged in. Otherwise, customs will have to go back to their bank account every day and see, okay, has this person sent in? They will have to go through all the lists of all the people who made CEFS transactions and check, okay, has this person paid? Has this person paid? Right? Here, automatically, it's linked to their systems now because the customer is directly putting the correct reference numbers and making the payment. Next, I wanted to put Lanka QR, but I haven't. I will do that for your information purposes. We have already discussed it, but the concept is the same. We've discussed it now, Lanka QR in length, how it becomes a fintech. To several examples. I will add the other scenarios there. It's just wondering whether to add it or not, just because it's very detailed and we give it a thought. Because there are 4 Lanka clear scenarios, but it matters when you are as a bank, like to tell your customer what the knowledge that you have now is sufficient. Because ultimately it goes to the customer's bank account, no matter how many routes it goes through, and it's standardized. So except when you are the merchant acquirer in terms of business model, except where you're the merchant acquirer, and we looked at how the fees get divided, the rest of the fees are fixed. So, the bank doesn't have a choice. Like the bank can't say, "Oh, I don't want this model. Like I don't want to take part in a model with a mobile app." It doesn't have a choice. It's a standard, and everyone has to follow it. When you are joining Lanka Clear, you all have to follow all the models. I just don't want to overload you all with things that practically you won't necessarily need to know. I'll give it a bit more thought and probably just I'll see how best to sort of give it to you without overloading you with a lot of information that it's interesting to know, but whether you will use that knowledge, I'll give it a thought. Yeah. Right. So why, coming back to what we were discussing, so why a new layer of fintech, right? So why? This was the question that I was asking, because sometimes when you're just looking at the pictures, the diagrams, it looks a little silly, right? Like why? This is already there, so why are we just putting another thing in? So this is the question. So a payment service provider or a payment platform enables merchants to join at a lower cost and at greater ease, right? So a lot of the developments and the approvals that you would need to get from a bank, you don't need to get from a payment service provider, not because the responsibilities have lessened or the gravity of the situation is less. It is because the payment service provider is already taking on that responsibility that otherwise the merchant would have to do. The payment service provider is doing on behalf of the merchant, and then they get a lot of merchants, so the cost balances out, right? Payment service providers give opportunities for merchants who cannot afford their own website or meet the IPG requirements of a bank to gain access to a third party. Acquiring banks get the opportunity to acquire merchants that may not meet the high prudential standards via a PSP, a payment service provider, right? So banks also benefit because customers that they otherwise are barred from taking, right? Customers that they are barred from taking, they can take because someone else is now bearing the risk. The payment service provider is taking up the risk, right? The technological risk. Mainly they take up the technological risk. The bank is still responsible for the merchants, right? The bank's responsibility hasn't gone, but the payment service provider, it's kind of outsourced to the payment service provider, right? And the bank has to now only check that the payment service provider is meeting all the technological requirements, right? They don't have to go and look at 20 merchants. They just have to look at one payment service provider. Here, the PSP absorbs the technological risks that a merchant could have so that the merchant may be able to gain access. So everyone it's a win-win for everyone, right? The merchant gets the IPG access for e-commerce, the PSP gets the business, right? The PSP absorbs the technological risks. No, that's the service that they're providing. They're absorbing the risks, right? And the bank gets more merchants using their IPGs, right? So everyone, it's a win-win for all. So benefits of fintech, we've discussed these on and off. So inclusive growth. Now, how does inclusive growth work here? Inclusive growth works because now throughout this I was discussing lower costs, smaller fees, right? Small merchants, um, customers with the phones, right? Or without the phones, if even feature phones, some of them can, if they are using Pesa and so on. So this is, and their businesses can grow, right? Their businesses go in, the money goes into their accounts, they don't waste their money. Their they have more records for things like to get a loan, right? Because if you're in the informal sector and you don't have um and you don't have records of your income, as people who work in banks, you know this, right? People can't just give loans to people. So this all allows them to have a better like to grow their business, and this cumulatively results in inclusive growth, right? And then expansion of financial services, right? And now we saw lending, crowdfunding, Robo Advisory, even the payment services. We see new actors have come in and they are providing different services to what the banks were offering, right? So financial services themselves are expanding. We are having new types of financial services. Another very famous one is this wealth management, right? And this sort of account management, right? Budgeting is very popular, especially abroad, because a lot of people, even now, things, a lot of our apps have the budgeting as well. Now, some apps abroad, they have this, you can put, okay, for a month, I will only spend this much on takeout. You can put that. So then you're paying through that app. You keep paying through that app. And then once it hits, let's say 5,000 rupees, you can't pay Uber Eats anymore or Pick Me Food or whatever anymore, right? You can't pay it for restaurants. So that the app just puts a block, right? So those are some of the sort of budgeting apps. And so it's good for people who want to budget well or feel that they don't have enough self-control. So what we are seeing is they're using technology and providing new types of financial services for different needs, right? They're quite versatile and they can custom make based on the customer's needs, right? Reduction of transaction costs, right? Reduction. So some we find intermediate. So transaction costs is the costs, not only things like MDR, but things for when you have a lot of intermediaries, right? Or the fees that you have to pay for different intermediaries. Now these are cheaper intermediaries. There are still intermediaries we saw, right? There are new intermediaries like the fintechs, the payment service providers. Those are new intermediaries, but they're cheaper intermediaries, right? So they're going for volume level. So that overall the cost is coming down, right? So financial inclusion, especially for merchants, especially with things like Naga QR, because they can access with their feature phone and a static QR code. So they come in. And then you have increased market competition. We are seeing this quite a lot because you can access the market really fast with mobile apps. and online advertising, and it's easier to give discounts. And like even on things like Uber, you can see Uber Eats, if you eat 10 times from this, you will get a discount, right? It's very easy to calculate it now. Sometimes there are restaurants, they give a little card. I haven't seen that in Sri Lanka, but abroad you see that quite often. They give a little card saying, okay, if you get it stamped 9 times, then the 10th one is free, right? So you don't need to go physically to the shop to do that, right? On Uber, they can just do, okay, 9 times, okay, now you're getting 1,000 rupees off or whatever. And so there's a lot more competition, right? And you find a lot of the alternatives coming up with these sort of offers and ways of the costs are coming down, right? Now, even with credit cards, we've seen that in Sri Lanka. We see that quite a lot, right? With credit card discounts. Now, people just wait for discounts because they know, okay, sometime around they will get discounts. Sometimes they apply for credit cards based on the amount of discounts. So this is market competition, right? If you are getting a lot of discounts, that means it's a very competitive market. Yeah, so those are the benefits of fintech. We will stop here today. Any questions? So for the exam, I will ask you about this, right? About how to differentiate between fintech and this sort of thing. I will ask you. The concept is the same. Whichever example that comes, the concept is the same. It is, you can see, using some tech. So these guys are tech companies, right? Like Epic and Pay here, WebEx Pay. Those are all tech companies, right? They are providing this service, right? If you go to their websites, you can see that they are PCI DSS certified, and they have taken the relevant certification. So it's not cheap. So it's not like someone. So joining, one thing about joining financial services is it's not like making an app for the app store, not like a game or something like that. You have to be regulatory compliant. You have to meet, even if you are a fintech, you still have to meet the regulatory compliance, right? So because the bank has the regulatory compliance burden, so the bank will expect the service providers and the merchants, whoever connects to comply as required. So you can't just say, oh, I'm a great tech firm, let me join. No, it's a process, and most of them have to come to the central bank to get it checked as well, whether it's done correctly. Mobile apps, they don't have to come to the central bank, but there is as we discussed the previous time, the board of directors are responsible to make sure that the apps are compliant to the minimum compliance standards. So that way, that is how you ensure the quality of all this fintech. Otherwise, people can lose money because the money is going through this person, right? So we have to make sure that this person is safe, this point is safe, this point is safe, this point is safe. All these points have to be safe. Otherwise, people can lose their money. So they also have to comply. So even if they are not banks, it doesn't matter. If they want to join the system, they have to meet the requirements. Right. If there are no questions, we can stop for today.